Ever wondered how you can make your money work for you month after month? What if I told you there's a way to earn consistent, reliable income from some of the most formidable companies across diverse sectors? We're talking about the titans of real estate, the financial lifelines for small businesses, and even the energy behemoths that keep our world turning. Each of these players isn't just performing, they're paying out dividends every month, making them a treasure trove for investors seeking steady income. But here's the question that might just keep you watching. With industries as varied as real estate, finance, and energy, which of these high-yield stocks could be the golden ticket in your investment portfolio? Let's dive in and find out. 1. Agree Realty Corporation, ADC. Born in 1971, Agree Realty has grown into a real estate titan, boasting over 18,000 properties that stretch across the U.S., covering an impressive 38.1 million square feet. Now, that is huge. Agree Realty stands tall in a sector where e-commerce and pandemic challenges have turned the tables. How? By aligning with retail giants like Walmart, Dollar General, Home Depot, and CVS Health. These aren't just tenants, they're stalwarts that bring stability and crowd appeal, keeping Agree Realty ahead of the game. But here's the cherry on top: diversification. Agree Realty isn't putting all its eggs in one basket. They've spread their risk so smartly that no single tenant shakes their foundation. They've even steered clear of riskier sectors, focusing on where the real growth is. And growth? They're nailing it, investing a staggering $1.7 billion last year alone to expand their empire. Now, let's focus on a critical aspect investors closely monitor: dividends. For the past 11 years, Agree Realty has consistently increased its dividends, demonstrating a robust financial stance and a strong commitment to rewarding its shareholders. Monthly dividends are now at $0.247 per share, annualizing to $2,964 per share, which is a testament to their stable and rewarding investment proposition. Highlighting their dividend performance, the company's current dividend yield is 5.21%. This represents a significant uptick of 335.97% compared to the average of 1.20% over the last 4 quarters. This remarkable increase clearly indicates the company's dedication to delivering value to its investors, showcasing a substantial yield that's hard to overlook. So, if you're all about investing in a company that's growing, giving, and glowing with potential, Agree Realty is where your attention should be. 2. Main Street Capital, MAIN. This isn't just any firm. Main Street Capital is the go-to for small and medium-sized businesses that find the traditional lending doors shut. They're like the financial superheroes for the underdog companies, offering a lifeline when they need it the most. Now, a business development company shares several similarities with a real estate investment trust. Both entities receive special tax treatment, provided they distribute at least 90% of their earnings as dividends. Additionally, they benefit from the current low interest rate environment by accessing inexpensive borrowing, which they can then invest in targeted sectors. With a firm belief in the company's imminent improvement, Main Capital is poised for continued success. By providing equity capital to lower middle market companies, businesses with annual revenues ranging from $10 million to $150 million, Main Street focuses on supporting vital yet often overlooked economic contributors. Despite their lesser-known names, these companies play significant roles in job creation and economic growth. As these companies thrive, they will generate higher income for Main Street Capital, thus bolstering its overall performance. Now, get this, a dividend yield of 6.66%. Impressive, right? In a world where decent yields are hard to come by, Main Street Capital stands out, doling out a monthly dividend of $0.24. And considering you can grab their stocks for around $43, it's not just a dividend play, it's a bargain. Dive into their portfolio and you're in for a treat. With investments in over 195 companies across 50 industries, Main Street Capital is like a financial buffet, offering a little something for every taste. This isn't just about variety, but strategic diversification, ensuring resilience and growth. The demand for funding is booming, and Main Street Capital is right there, fueling businesses and, by extension, their investors' portfolios. Their robust earnings cover those generous dividends, signaling sustainability and stability. But here's the kicker. It's not just the dividends that will have you grinning. The stock itself has surged 20% in value in 2023. So while you're collecting those dividends, your investment is appreciating too. Talk about a win-win. 3. Gladstone Capital Corporation. Glad isn't your average financial entity. It's a powerhouse providing high-interest loans to those often overlooked small and mid-sized companies in the U.S. Think of Glad as a venture capital firm's cousin, but with a twist. It's a business development company, which is like a public, closed-end investment company but with a laser focus and some unique features. But why are investors buzzing about BDCs? Well, they're a hot ticket for anyone keen on generating income. BDCs, like Glad, are all about sharing the wealth and distributing most of their earnings to shareholders, which translates to attractive yields. Speaking of which, Glad boasts a dividend yield of 9.89%. Now that's a figure that makes you sit up and take notice, especially when you stack it against the S&P 500's average yield of just 1.6%. But Glad isn't just about impressive yields. It presents an intriguing value proposition with a market cap of around $459.89 million and a P/E ratio of 7.3. The firm isn't just sitting pretty, it's on the move, with a whopping 36.34% revenue growth over the last year and a 20.35% quarterly growth rate in Q1 2024. For the dividend enthusiasts, Glad is a stalwart, maintaining its dividend payments for an impressive 24 years. That track record speaks volumes about its commitment to shareholder returns. Peek into Gladstone's Capital Corp's financial for the December 31, 2023 quarter, and you'll find a mix of twists and turns. Here's the scoop. The total investment income slightly dropped 2.3%, landing at $23.2 million. Why the drop? It boils down to decreased interest income and a few other sources, including a notable dip in prepayment fee income. While the income wavered, there's a silver lining: expense management. The company trimmed its total expenses by a sharp 11.6%, a savvy move that boosted its net investment income by 8.6%, reaching $11.9 million, or $0.274 per share. That's right, even amidst income fluctuations, they found a way to come out stronger on the net side. Let's not overlook the net asset value per common share, which ticked up by 2.3% to $9.61. As for the investments, there's good news too. The total investments at fair value rose by 6.4%, hitting $749.9 million. But here's the real headline catcher: a net unrealized appreciation of $7.8 million, propelling a 52.7% net increase in net assets resulting from operations. So, what's the takeaway from Gladstone Capital's latest financial chapter? Despite the ebbs in investment income, their strategic financial maneuvering softened the blow and carved a path for growth in net investment income and asset value. 4. PennantPark Floating Rate Capital, PFLT. This one is a unique player in the investment field that focuses on generating income and capital appreciation through floating rate loans and other investments in U.S. middle market companies. Here's why they stand out. PennantPark zeroes in on middle market companies. In this niche, they see a golden opportunity due to the limited capital availability to these firms and the potential perks of rising interest rates. They make their money by collecting interest income on debt securities and pocketing dividends, a strategy that's been paying off quite well. Since 2011, PennantPark has been sharing the wealth with its shareholders, paying out monthly dividends like clockwork. But they're not just consistent, but also climbing the dividend ladder. Since 2012, they've upped their dividend game annually, earning the prestigious title of a dividend achiever. That's no small feat. It's a badge of honor in the investment world, highlighting their commitment to growing shareholder value. As for the numbers that lighten investors, PennantPark boasts a 12-month trailing dividend yield of 10.95% and an even more promising 12-month forward yield of 11.01%, hinting at brighter dividend days ahead. While their annual dividend growth over the past 3 years was modest at 1.30%, and even more conservative at a 0.60% over 5 years, the big picture over a decade reveals a steady 0.90% growth rate. Crunching the numbers for the future, the 5-year yield on cost for PennantPark stocks hovers around 11.28%, painting a pretty attractive picture for investors looking for a steady income with a touch of growth. 5. Sabine Royalty Trust, SBR. And finally, let's take a closer look at this standout player in the oil and gas, exploration and production industry, especially regarding dividends. As of April 8, 2024, SBR is turning heads with a relative dividend yield of 8.7%, which towers over the industry median of just 1.7%. But that's not a one-time wonder. Last year, their yield hit an impressive 11.5%. This Express Trust is no ordinary entity. It's a vessel designed to harbor Sabine Corporation's royalty and mineral investments. We're talking about a portfolio that includes landowners' royalties, overriding royalty interest, and minerals production payments, spanning across states like Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. These properties are not just spots on the map. They're the lifeblood of the trust, pumping out value for shareholders. Over the last 5 years, SBR's dividend yield has consistently averaged 8.7% annually, showcasing its ability to deliver solid returns in a fluctuating industry. This performance isn't just a testament to the trust's asset quality, it's a beacon for investors seeking robust yields in the energy sector. Moreover, the future outlook for the oil and gas exploration and production sub-industry appears largely positive. Following the significant oil shock triggered by the COVID-19 pandemic in 2020, crude oil prices have gradually rebounded, currently hovering around $60 per barrel. This recovery can be attributed to the ongoing supply cuts enforced by the OPEC Plus consortium. With favorable industry dynamics and Sabine Royalty Trust's solid performance, investors may find themselves drawn to the potential for robust returns and steady dividends in this sector. And that's a wrap. From the energy corridors to the bustling real estate markets, these monthly dividend champions are set to redefine the art of income investing. If you could choose only one of these top-paying dividend stocks to rely on for the next decade, which one would it be and why? Comment down below. And leave a like, subscribe, and turn on the notification bell.